Imagine waking up to a $93 million deposit in your bank account just because the Supreme Court rewrote a rulebook. That is basically the quarter Keysight Technologies just had. Welcome to Earnings Unscripted. It is May 19th, 2026, and we are unpacking Q2 for Keysight, ticker KEYS.
Yeah, a legally mandated blowout quarter. And just a quick note before we completely dissect their P&L, this is not financial advice, just our personal opinions.
Right. So on paper, the headline numbers look incredible. Revenue came in at $1.72 billion. Diluted GAAP EPS was 2.02, up nearly 24% from last quarter. And operating income, up 64% sequentially? That looks like a misprint.
Well, it kind of is. I mean, not a misprint, but a massive GAAP distortion. The Supreme Court struck down these international tariffs, so Keysight had to dynamically rewrite the quarter. They basically got a $93 million credit to cost of goods sold.
Wow.
Which artificially balloons that operating margin. But they also had to shave $40 million off top-line revenue to refund pass-through surcharges to their own customers.
Okay, so stripping away the courtroom drama, what is actually happening with their core business? Because they act as the physical toll collectors of the AI boom, right? They test the actual hardware tech giants use. Like at that optical conference recently, they were on the floor with NVIDIA proving out those insane 1.6 terabit connections.
Exactly. People forget AI needs physical copper and glass. If you buy billions in GPUs, you cannot risk latency in the cables connecting them. So their commercial communication segment jumped to $858 million. That is up 13% from Q1. And total orders just hit a record $2.05 billion.
Which probably explains the whiplash in the aftermarket, because looking at the tape, the stock had a huge quarter overall, up over 55%, thanks to a massive gap up back in February. Then today, the initial after-hours print spiked to 383, but almost instantly faded back down to around 346.
Right. It gave back almost $40 before the call even finished. Investors saw the record AI bookings, bid it up, and then digested the tariff noise and realized margins have to step down next quarter once the rebate is gone.
A reality check, essentially.
Pretty much. But underneath all that accounting noise, demand is running so hot they actually raised their own capital expenditures by 25% mid-year. Hardware firms do not just casually do that unless they're really scrambling for capacity.
That's a huge tell. All right, let's get into the details on that capacity strain and cash flow.
Yeah, so bumping capital expenditures from 160 to 200 million halfway through the year is not a small tweak. In hardware, you generally set your CapEx budget and live with it.
Right, because building physical assembly lines takes time. It is not like spinning up another cloud server.
Exactly. And it tells us that their new product introductions, the NPIs, are just blowing past whatever internal manufacturing models they had built. They are literally racing to build the tools that build the AI data centers.
That's incredibly meta. We are hitting the physical limits of manufacturing the equipment that is used to test the physical limits of the internet.
That is actually a great way to frame it. And Satish Dhanasekaran, the CEO, made this crystal clear on the call. He said, and I'm quoting here, "In the first half of fiscal 2026, our AI-related business has already surpassed the levels achieved in all of 2025.
Wow. So in 6 months, they beat an entire 12-month cycle? Okay, but how does that translate down the income statement? Because surging revenue is great, but if they're emergency spending to keep up, does that just crush their margin?
Well, no, and that's perhaps the most impressive technical part of this quarter. You would think the emergency capacity build-out kills efficiency, but they're getting near a 50% operating leverage on their organic growth right now.
Wait, so half of every, or I guess close to half of every new dollar is dropping straight to operating profit?
Give or take, yes. Neil Doherty, their CFO, explicitly called out their tightly managed expenses, allowing them to outperform on the incremental. They are just running the machine incredibly hot. The flow-through is kind of wild for a physical hardware business.
But surely there's a stress point here, right? If you're running at red line and demand is still pulling, things start breaking somewhere. Are we seeing that in lead times, maybe?
Yeah, there it is. That's the hidden risk in this report. Neil mentioned they're seeing orders for semiconductor and actually aerospace systems moving toward the longer end of their lead times. We're talking 3 to 6 months out for delivery.
Which on one hand sounds like a fantastic problem to have. I mean, a 6-month backlog is a pretty cozy revenue buffer if the macroeconomy decides to stall late this year.
It definitely protects the downside temporarily, but in a volatile component market, if you lock in a price today and cannot deliver for 6 months, you eat any cost spikes in between. Plus, if hyperscalers suddenly change their network architecture while they wait,
customers might get frustrated and just cancel those unfulfilled validation orders.
Precisely. A 6-month backlog can turn into vapor if the tech cycle pivots while you are still trying to ship last quarter's standard.
And we already know the technology is moving insanely fast right now. They were just talking about how customers aren't choosing between open standards or closed architectures anymore.
Right. Satish pointed out that it is no longer optical versus electrical. It is both. So Keysight has to build these highly complex test environments for an impossibly broad spectrum of tech simultaneously. And it goes beyond just data centers. That aerospace lead time stretching out is partly driven by space tech.
Wait, space tech? I did not realize they were that deep into the aerospace side.
Oh, yeah. They're testing positioning, navigation, and timing systems for low Earth orbit satellites. Basically, customers can use Keysight's integrated tools to simulate extreme space altitudes and dynamic connection losses on the ground so they can stress test a network before actually putting a rocket into orbit.
Okay, that is just genuinely cool. But it brings us right back to that CapEx raise. They're throwing money at internal capacity because they literally have no other choice if they want to catch these simultaneous waves in space and AI.
It is a high-stakes game of physical catch-up. But to be fair, the balance sheet looks completely fine handling it. Free cash flow was actually $472 million for the quarter, so they have the cushion.
That is undeniably solid cash generation. The core engine is humming, even if the warning lights on the dashboard are blinking a bit about those delivery windows. So, considering all this internal strain, where does it leave their trajectory heading into the back half of the year?
Management is actually surprisingly confident. Neil Dougherty guided Q3 revenue to, I think it was between $1.73 and $1.75 billion. So that implies roughly 29% year-over-year growth at the midpoint.
29%. For a hardware testing company of this scale, that is almost software level growth.
Right. And he even dropped a quote saying they are on track for revenue growth in the high 20% range for the full fiscal 2026. They also see next quarter EPS landing around 2.43 to 2.49. The underlying momentum is just undeniable right now.
Sure, but we cannot forget the accounting distortion we just talked about. Once Q3 hits, that $93 million tariff rebate completely vanishes. GAAP margins are going to have to step right back down to earth.
Oh, absolutely. Analysts are going to spend the next 12 months building complicated bridges just to strip out that tariff noise. And I would also caution people to watch their recent acquisitions like Spirent. Those deals lean heavily into recurring software models, so that revenue recognizes a lot slower than a standard piece of hardware.
Right, so you get this short-term drag on top line while the integration sort of plays out in the background.
Probably. But look, zooming out, the biggest takeaway here is that AI is not just a software game anymore. It is hitting physical infrastructure constraints. And Keysight has basically positioned itself as the foundational validation layer for all that physics.
It is the ultimate gold rush setup. They are not out there mining the gold. They're just running quality control on everyone else's shovels.
Exactly. It's a multi-$100 billion supercycle, and Keysight is just standing at the toll gate.
That is honestly the perfect image to wrap this up on. We will definitely keep tracking them to see if they can clear that massive backlog smoothly. Thank you so much for joining us today on Earnings Unscripted. Take care.
See you next quarter.
If you want these earnings chats to just show up when they happen, feel free to follow the show in your player. And as a quick heads up, This podcast is AI assisted, which is basically how we turn a mountain of dry SEC filings into a normal conversation so fast. We would love to hear what tickers you want us to dig into next. So just send an email to earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out with us.
Take care, everyone.